So you've probably got your investment portfolio set up. It has that nice, comforting Sharia-compliant label on it, and you're thinking, okay, I'm good. My money is completely clean and safe, right? Well, actually, I want you to think again. Welcome to this explainer. Today we're going to challenge a really dangerous assumption. There's a silent, completely invisible cost that's eating into your investment gains literally right now. And the crazy part, most halal investors are completely ignoring it. We're going to break down exactly what's happening under the hood and, more importantly, how you can put a stop to it.
You really have to ask yourself, is your perfectly clean portfolio actually bleeding value? Look, for years, faith-based investors like us have done the hard work. You've diligently screened out the interest-based debt, you've completely avoided the alcohol and gambling stocks, and you felt pretty secure doing it. But while we were all focused on those traditional screens, the global economy fundamentally shifted right under our feet. It transformed into this high-volatility, heavily tech-driven machine. And because of that massive shift, there's a new structural cost quietly siphoning value away from your long-term wealth. And honestly, it's happening way faster than you can probably track.
Okay, let's just dive right into it. We're calling this high volatility drain the AI tax. Now, it's not a literal tax levied by the government or anything like that. It's a structural imbalance, but it is relentlessly draining the value of your savings just the same. In this explainer, we're going to investigate exactly what this AI tax is, why your carefully chosen faith-based investments are losing value to tech inflation, and best of all, how we can systematically spot it and fix it.
To really understand how we got here, we kind of have to look back to late 2024. Apps like Zoya were heavily updating their screeners. Then, by December 2025, major global warnings started hitting the news, which leads us right up to our current landscape in April 2026. The macroeconomic stage has basically been set by two incredibly volatile forces. First, you've got massive geopolitical instability, and second, the aggressive, totally nonlinear adoption of artificial intelligence. We're operating in this fragile economy where global supply chains are really struggling. They're trying to adapt to the immense pressure of those geopolitical tensions combined with the incredibly rapid, astronomically costly integration of massive AI data centers.
And you know, this isn't just some theory I'm throwing out there. It has massive institutional backing. The OECD warned about this back in December 2025, and recent special briefings from the Volcker Alliance have completely echoed it. These forces are testing the very resilience of the global economy. While AI is absolutely driving growth, the massive energy and infrastructure costs associated with running it are fueling persistent inflationary pressures. And here is the real kicker. Your standard market indices, they aren't fully capturing this tech inflation.
So let's break down the mechanics of this AI tax so you know exactly what to look for. For the Muslim investor, even if your stocks check all the standard boxes and get deemed halal by traditional screening criteria, the underlying companies themselves are essentially trapped. They're being forced to spend billions on AI integration just to survive the race. And how exactly do they fund that? Well, they fund it through equity dilution, which essentially means issuing more shares and making the ones you already own worth less, or by severely reducing research and development in their core stable products. That directly and negatively impacts the long-term share value of what you are holding.
Which brings us to what I like to call the hidden trap. There is a massive, super dangerous gap between the surface-level safety of a Sharia label and the actual business reality of high-risk AI cash burn. We're kind of being misled by the label of Sharia compliance into completely ignoring the underlying quality of the business model. Think about it. In an AI-saturated market, a compliance label simply does not protect you from a deteriorating business model that is hemorrhaging cash left and right.
And the numbers? They are absolutely staggering. When you compare the sheer scale of the capital expenditure being poured into speculative AI against the tiny fraction spent on core product R&D, it's honestly alarming. You might look at recent performance data for major Sharia-compliant ETFs and see top-line growth, but are you looking at the net return after adjusting for this massive capex? These companies are pouring astronomical amounts of money into servers and chips simply to keep up with their competitors. They are burning cash faster than a rocket leaving the atmosphere.
We are literally talking about billions of dollars in cash burn risk here. Many of these halal-screened tech stocks are currently trading at wildly optimistic valuations. Those valuations assume aggressive, AI-driven revenue increases that, realistically, might not manifest for years. Meanwhile, these companies are just burning cash to compete in the AI race, while the Federal Reserve maintains a strict policy stance. It is an incredibly precarious financial position for any company to be in, and by extension, for your portfolio to be in.
Which really forces us to stop and ask this critical question. Are you investing in a solid, fundamentally sound business, or are you essentially funding a high-risk tech gamble? Because if a company in your portfolio is doing the latter, it fundamentally does not align with the traditional asset-backed principles of Islamic finance. We have to pivot our thinking here, guys, because the data shows a really deep disconnect between what we think we are holding and the actual reality of those companies' balance sheets.
And this is exactly where a financial problem becomes a deep spiritual problem. Enter the concept of hifz el-mal, the preservation of wealth. This isn't just good financial sense, it's a core objective of Islamic law, the maqasid al-Sharia. When you invest in companies that are over-leveraging their own future to chase speculative, AI-driven growth, you are actually abandoning the conservative, value-based financial stewardship that is supposed to define a Muslim's wealth.
So there is a stark line we really have to draw here. On one side, we have passive screening. Blindly trusting an ETF label exposes your family to prohibited gharar, or excessive uncertainty, because you're completely ignoring the fundamental financial health of these companies in a really unforgiving economic climate. On the flip side, we have active stewardship. In an era of high inflation and geopolitical conflict, real stewardship demands that your wealth is in businesses that produce tangible value and essential services, not just tech companies riding a speculative bubble, hoping it doesn't pop.
So how do we actually fix this? How do we move from that dangerous passive screening to powerful, active financial stewardship? Well, we need a resolution. I've distilled this whole thing down into a clear 4-step action plan that you really need to implement immediately to protect your portfolio from the AI tax. We are going to audit, diversify, reevaluate, and automate. Let's break down exactly how you execute each of these steps so you can take back control of your wealth.
Okay, step 1 is to audit your holdings, but we are going way deeper than the surface here. I want you to pay special attention to one specific metric, the CapEx to cash flow ratio. You can use great tools and apps like Zoya, Halal Wallet, or Musaffo to help with this, but please do not stop at the Halal checkmark. Dig into those financials. The trigger is crystal clear. If a company in your portfolio is spending more on speculative AI infrastructure than they are on core product innovation, it's time to seriously consider divesting. Remember, they are literally burning your future value.
Moving on to step 2, diversify tangibly. To build a truly resilient portfolio, you need to shift a portion of your wealth away from pure tech exposure. The goal here is to build defensive moats around your money. You do this by moving into sectors with physical, tangible assets. Think commodities, logistics, or infrastructure that provides essential everyday services. These are the heavy-duty assets that hold strong during times of high inflation and crazy technological volatility.
All right, steps 3 and 4. If you happen to hold a broad market halal ETF, you absolutely must check their top 10 holdings. If those top 10 are completely dominated by AI hype cycle stocks, your portfolio is unbalanced, period. You need to balance that heavy AI exposure with individual, lower beta stocks, meaning assets that are a lot less volatile and offer long-term stable growth. And finally, step 4. Secure your financial baseline by automating your zakat payments based on your total liquid wealth, not just your profits, to ensure you maintain barakah, or spiritual blessing, in your remaining capital.
Ultimately, everything we've talked about in this explainer comes down to this core philosophy. Your wealth is a trust from the Creator. It is not just a bunch of numbers flashing green and red on a brokerage screen. We live in a financial world that is actively designed to distract you with the promise of growth at literally any cost. But the true halal investor, they find immense power in clarity, in patience, and in the sheer courage to refuse a speculative trend when it goes against fundamental values.
Think about it. You have already done the hard work to protect your wealth from the prohibited elements of the past. The big question now is, will you actively protect it from the high-risk speculative forces of the future? Don't let this invisible AI tax silently drain your hard-earned savings. Take out your portfolio, run that 4-step audit today, and start investing in a future you actually believe in.